For more clues on the path for rate policy, our next guest expects overnight rates to be higher for longer, and he doesn't see any cuts until later in the year. Joining us this morning, TD Cowen President Jeff Solomon is back with us. Jeff, it's great to see you again. Good morning.
Good to see you too, Carl. How's it going?
Pretty good. The street's been peeling off some of these cut expectations. You think market's still too dovish?
Yeah, a little bit. Like I've been saying for a while, I think it's going to be higher for longer. I think the reason we're going to be higher for longer is because the U.S. economy is doing just fine. Like I think if you look at the strength of the consumer, you look at unemployment data, like it's still pretty good. And so the Fed has a lot of cover to leave rates higher for longer until they can actually see that inflation is in check. And that's what they should do. I really have been a big fan of making sure that inflation doesn't get away from us. And higher for longer means that they'll be on the case, make sure we don't have a problem longer term.
We're getting a jobs number Friday. We're waiting for some of these WARN notices to creep their way into, say, jobless claims at least. But I guess you're not expecting any material weakness in the labor front.
Not for the foreseeable future. Look, we'll see the sum total of these job cuts. We have a lot of, though, inflationary tailwinds, like the reshoring of businesses, the rebuild of the U.S. infrastructure, different supply chains, like. That's all very inflationary when you think about the amount of building that has to go on, the amount of jobs that have to happen that come back to the United States. So I think there's some longer-term elements of the new geopolitical framework that we're dealing with that probably put an underpin the jobs numbers for some period of time.
Yeah, I'm going to give you credit, Jeff, because you were on with us and the market was pricing in 6 cuts, maybe even looking ahead to 7 cuts for the year. And you were saying, wait, like that is not going to happen. Way too optimistic. And you even thought, I think, that the rates should have gone higher at some point before going lower, which is the anticipated next move. What is it? Do you think inflation is going to stick around?
It's going to be around for a while. So what I said, I think the last time I was on was right before a Fed meeting, and I said I thought the Fed should just hike one more time and then say we're done.
Right.
I didn't think they would. I think I said that's what they should do, but they won't do that, and they didn't. But again, I'm not in the inner circle there. So what I'm saying is I think they could just afford to stay higher for longer, and they are. I just think there's no reason. By the way, the rally in risk assets and the rally in credit has given them ample cover to stay higher for longer. So I think you'll hear probably from the Fed chair that they're going to be on the case and they're going to talk it down. And I wouldn't be surprised to see some equity volatility here. Take some of the, if there's perceived to be fraud, I'd take that out of the market. But that's fine. It gives them tremendous cover. And I think the market is reacting to this idea that the next move is going to be down and that the Fed has room for the first time in 15 years to cut rates meaningfully. Like, don't discount that, right? We've lived for 15 years in a zero interest rate environment. So now people are like, yeah, they could cut a couple hundred basis points if they need to. That's a great tailwind.